Okay, yesterday's video we talked again about cyclicality, and obviously it's an important concept to understand both the nature of cyclicality, where it can show up, and kind of use it as a way to invest, a way to prevent yourself from getting separated from your money, but also to find opportunity. Today I want to talk about the opposite. Basically, if you think about cyclicality as a type of mean reversion, of things returning to a mean over time, exceeding it, going below it, but then kind of centering around some mean level. There are examples in the investing world of the opposite of this, and maybe we could call it mean aversion, but examples where companies have long-term structural advantages that can produce excess returns for investors. And the textbook example of this comes from Geico and Warren Buffett's investment career. Years ago, he discovered that basically because Geico didn't use brokers, independent brokers, or a broker network to sell its insurance products, instead it sold its insurance direct, there was actually a structural cost advantage that Geico had over the rest of the industry. And it was basically something that allowed them to sell all their products for a little bit better price and constantly gain market share against the rest of the industry. And this turned out to be a multi-decade structural advantage, and it was one of the reasons that Buffett had a lot of success with this business, and it threw off a lot of cash flow for his company. I think now we could talk about, say, for example, Amazon. This is obviously in retrospect now, but Amazon had significant structural advantages over the entire universe of physical retail, of traditional retail. Its cost structure was lower. It had just certain infrastructural advantages that regular retail couldn't compete with, basically. And this is a long-term structural advantage. It may still be a long-term structural advantage, right? If you think about, say, the FANG stocks, or actually Apple is a really good example, what it's doing to the cell phone industry, and actually what Nokia did to the cell phone industry back in its day, say the late 90s, early 2000s, and Apple did this to Nokia as well, basically just is creating much superior products, and also has significant scale benefits because of the superiority of its products, and therefore it can both sell better products for much less because they have so many volume advantages. So in the late 90s, early 2000s, Nokia was garnering more than 100% of the profits of the cell phone industry. Likewise today, Apple's doing the same. And ironically, Nokia had a structural advantage, but it wasn't permanent. It lasted for a period of years, and then they lost their structural advantage to Apple, I'm sorry. So the whole idea here is to recognize this structural advantage, and it could be an example of scale or size, could be a function of your market share, or it could be some other arbitrary circumstance, like Geico's marketing method, which was lower cost, structurally lower cost than the existing industry, or Amazon, where basically just the idiosyncrasy of physical retailing having certain cost structures that weren't present with online retailing. So when you can find a situation like this, often you just buy the stock and put it away, and you just keep an eye on what is the nature of the structural advantage, and just let it compound for you as it eats away at the existing competition that lacks the structural advantage. So these are kind of examples of increasing returns to scale, increasing benefits, and a lack of mean reversion. So, just like in investing, there's lots of ways to suffer. Also in investing, there's no hard and fast rules, right? So all these discussions I've given about cyclicality, well, here's an example that's like a genuine exception to those rules, right? So in investing, I guess the exception is the rule. So here's an example where there's certain investment opportunities that come from a lack of cyclicality or a lack of mean reversion. And I guess it just goes to show that there's only heuristics in investing, right? There's no such thing as an algorithm, right? There's no rule that always works all the time. But here's one example where if you can find a mean aversion type of situation, a company with a long-term structural advantage, this is the mother lode for investing, and we've seen some great examples over the past couple of decades. The whole question is, what might there be in the future that would be an example of this that we could benefit from, okay? And obviously that's for you to figure out. So thanks as always for watching.